I welcome you all to the Take Solutions Limited Q1FY21 earnings conference call. From the management, we have on the call today Mr. H.R. Srinivasan, Vice Chairman and Managing Director, Mr. Shobana N.S., Executive Director, Mr. Lalit Mahapatra, Chief Financial Officer, Dr. Ayaz Hussain Khan, Global Head of Generics, and Ms. Soumya Kaur, Clinical Head for APAC, Take Solutions. I would like to mention that some of the statements made in today's discussion may be forward-looking in nature. The nature involves a number of risks and uncertainties that may lead to different results. So with this, I would like to hand over the call to the Vice Chairman for his opening comments. This will be followed by a Q&A session. Over to you, sir. Thank you.
Thank you, Jill. Good day, ladies and gentlemen, and welcome to the Q1 FY21 earnings call of Take Solutions. I have to acknowledge that this has been a very challenging quarter and perhaps the most challenging quarter. But before we delve into the call, I think it's like every one of us, the company and we at Take Solutions are enormously grateful to our COVID-19 warriors, such as medical professionals, civic workers, law and order personnel, and several others who are risking their lives every day to keep us safe. They're really the true heroes of this crisis, and they inspire us all. This quarter, I think we have done a very phenomenal job of taking care of our fellow employees as well as of our customers. But as I delve into the financials, I think it is very important to paint the landscape of what is happening in the biopharma R&D sector. The COVID-19 has impacted the biopharma R&D sector to a great extent. The clinical trial work, which forms a considerable part of our revenue, is the contact-intensive work and almost came to a standstill during the first 2 months of the quarter, which is April and May. It has been observed that almost all R&D groups across the world have been disrupted and are running under business continuity plans. The capacity utilization of R&D labs in the US dropped to around 5 to 10% of their total capacity. While it has picked up, it is still below 50%. Almost 2/3 of the pharma companies have halted some or all of their trials, and a majority of clinical trials in phase 2 and phase 3 were in regions with partial or full lockdown. This has severely constrained the demand environment and the ability of companies such as ours to service clients. I call this out because in some sectors like, let's say, an airline industry or a retail industry, the demand or lack of demand is visible because of the lockdown and the restrictions. Whereas in industries such as biopharma R&D, it may not be as apparent as or visible. There are 3 fundamental areas where this disruption occurs. First and foremost, we use what are called as sites, which are hospitals or clinics, to do clinical trials. And at this point of time, clinical trial is treated as elective. So most of the sites have been converted to treating COVID, and they're not available for clinical trials. The second reason is that these trials are usually conducted on patients and on healthy volunteers. This is not a time where patients or volunteers are coming forward for trials. And there is published data that says that the patient recruitment in the month of May is down 95% year on year compared to 2019. The third one is that there is a supply chain disruption that takes place on the samples, availability of samples and taking them back to the labs. So overall, the first quarter we saw the macro environment being disrupted. But a positive impact of this has been the accelerated adoption of technology-driven clinical trials as the new normal. And we are seeing a major shift in how the clinical trials are conducted, and there is a push from regulators as well to adopt steps such as trial virtualization, remote monitoring to ensure patient safety. I'm sure you're aware that we have a very strong background in technology. We do platform-based services. In the clinical space, we have one clinical. In the regulatory space, we have several offerings of pharma-ready, safety-ready, RIM-ready. So we are ahead of the curve in enabling the platform that have capability to deliver great results. And our domain expertise and technology combined with each other gives us that edge. Now, coming to the specific impact of COVID-19 on Take Solutions, the major casualty for us has been our European operations. We were this started way back in February 2020, where we started seeing initial signs and the initial shutdown came in from Europe. Our first priority obviously was employee safety, and we very quickly moved to protect the safety of our employees and brought in place all the business continuity plans that were there. We could see an accelerated drop in revenue, and some of our facilities were completely shut during the months of April and May. In fact, to give you an example of what happened during the first 3 quarters, I'm now going to invite my colleague, Dr. Ayaz Hussain Khan, to maybe talk us through 1 or 2 examples of our bioavailability and bioequivalence studies. And then I'll pick on from there again. Dr. Ayaz?
Yeah, thank you, Mr. H.R. Srinivasan, for this opportunity. And let me just give you a view of how these bioequivalence studies operate. So these are typically done in healthy volunteers, which come under the phase 1 evaluation of a product being tested. While what happened is with the lockdown kicking in, we had some of the studies which were partially done and then had to be stopped abruptly in between. So that was the first impact that we had when this happened. The second impact that happened was that when after the lockdown finally got over and then we were allowed to start off with the operations, then we picked up the studies which were scheduled, and as you are aware, these are time-bound studies, so we have to complete it within a specific time period. So we initiated these studies, but to our surprise, we got many subjects who were actually positive with the test that we were doing. So that indicated us that we need to have additional measures and checks and balances with respect to initiating the operations. So now we are finally back with the operations coming in with a lot of restrictions that we have put in terms of the volunteers who participate in our studies. So they go ahead with an initial testing to find out whether they are whether they have symptoms or not. We still first go ahead to do the testing, and then we first figure out whether they are negative, and then only they move ahead with their further screening for participation in the studies. As Mr. Srinivasan said here, we had a lot of impact in terms of the business continuity, because we have to work physically with the subjects in our facilities across locations, where we have our hospital setups, where we have beds, where we use those beds for taking up the studies. So the second portion of the problem that happens is that once we have the samples, then the logistics, of course, was a big hurdle. But now, with the easing up of the transportation and also other available means, we are able to send samples for testing. Interestingly, we have been very fortunate to have many COVID-related studies, and in our clinics on today's date we are running studies which includes COVID particular therapeutic leads, which are drugs or going to become drugs, with the testings that we are doing both in our healthy volunteer setup and as well as in the patient setup. Thanks, Mr. Srinivasan, for giving this opportunity.
Thank you, Dr. Ayaz. Yeah. So as you see, in the first quarter, our capacity utilization across our facilities was between 10 and 15%. Now, our manpower capacity utilization was only between 25 and 30%. This obviously impacted the revenues substantially, and we were down on revenues. Our order book today stands at about $173 million, and this includes the COVID studies. We've won 6 COVID studies in that. Now, in the first quarter was dominated by the regulatory and pharmacovigilance business, which is data-based. But I have to call out here that all that data, the primary source of data is clinical trials. So it is only a lag indicator. And we really need to be aware that during the first half of FY21, the demand is expected to be a little soft until normalcy returns. But I'm very sure that normalcy will return soon. We are already seeing an uptick in the site operations. And we are also delivering very innovative solutions in clinical trials. So I do foresee that the first half of this FY will be soft for us. And we are taking several measures to address the concerns that we have as management and address the concerns that you have as shareholders. But there are some exciting turns and some exciting possibilities that are happening as we step up to a new way of doing trials. And at this juncture, I'd like to invite Soumya Kaur, our head for APAC Clinicals, to come in and maybe give an example of some of the exciting work that we're doing. Over to you, Soumya.
Thank you, Mr. Srinivasan. Just to add in terms of the uptick in virtual clinical trials, as Mr. Srinivasan did mention, we did see a time point when the need of the hour in the industry was in terms of the treatment of COVID patients. And that was a time point when we actually picked up one of the studies in one of our existing engagement, and we were able to deliver that study within a matter of just 30 days. We were able to deliver the first cut of the data to the client. And with this, almost on a commando mode, where the team actually worked together in terms of delivering the results, and also in terms of the agility and the flexibility and the technology adaptation, what we actually did for this execution of this particular study, it gave us a very good momentum in terms of getting more COVID studies into our portfolio. So as of today, we are working almost 6 to 7 clinical trials which are just focusing on COVID, which is on patients. And this, we are able to build a model where in a virtual mode, we are sitting in various locations and the sites are in different locations. However, we are able to get the data and deliver the data as per the regulatory requirement and adhering to the requirement of the client. So this has pushed the industry, the way the industry is moving in terms of moving into a virtual mode of conducting the clinical trials. We internally have been able to deliver this to the client, and this we are actually able to execute to not only one study, but these lessons we are actually leveraging to the future studies of the other clients as well. And also we do see, even in the COVID scenario, with the adaptations of technology, the process and the operations, how we are currently managing the clinical study of COVID, we are in a position to adapt this not only to COVID, but also to non-COVID studies. So we do see a momentum, and also we do see a pickup in terms of a non-COVID studies where we are able to adapt some of these lessons learned to those studies as well. So in this current situation, as a team, from a team perspective, from a process perspective, from a technology perspective, we were able to pick it up in terms of execution and also in terms of how we can look forward for the future way of working in the clinical development arena. Thank you, Srinivasan.
Thank you, Soumya. So just to call out the data points on what Soumya said, in this study, the first patient in was 30 days from the date of award of the study. And the last patient, last visit was 36 days from there. So it's a very accelerated study and an outstanding performance for which the client has given us a lot of credit. And we've now expanded the trials into Middle East and into the US geographies as well. Obviously, that's the silver lining, but overall, we need to remember that we did have a poor quarter in terms of revenues. But the BD activity has picked up significantly. In fact, I'm happy to say that at the time of going into this call, the level of RFP activity has come back to pre-COVID levels. But there's always a lag between how the level of RFP activity operates and how the revenue cycle operates. But it gives us a sense of buoyancy as we move ahead. What we had to do in these tough times was really take two very strong efforts. One was to conserve cash, and the other was to bolster liquidity. In terms of conserving cash, I think we took three very important steps. The first was we realized that our EU business will bleed, so we had to take strong steps towards that. And you would see that we have made an exceptional provision of 156 crores or $20.7 million during the quarter for that. It was a difficult decision, but we had to take that to conserve cash. The second one that we've done is we've tried to reduce the real estate footprint that we have. And third, we have reduced the number of employees, especially across the Western geographies where the cost of the employee is higher. So we are relying on a lot more offshoring now and the ability to service a lot of work out of India. This is what we've taken in terms of conserving cash. We are also taking steps to bolster liquidity. So you would see that we've concluded the sale of one of the subsidiaries or the joint ventures in the supply chain space. Yesterday, we've got the approval from the board, and we hope to consummate this transaction by the end of this month. Coming to the financials, I mentioned that it was a worst hit quarter due to COVID, and the revenue this quarter was about 166 crores, down about 55.1% in rupee terms, and about 57.8% in dollar terms on a Q-on-Q basis. I'm not comparing it with Q1 of FY20 because the year itself is very different and the basis for comparison does not exist. However, you will note that compared to Q4, our operating metrics have improved tremendously. That is because of all the difficult steps that the company has taken to conserve cash and quickly return to cash profitability. The improvement at the EBITDA level is due to these rigorous efforts. We've used a combination of wage cuts, headcount reduction, offshoring, tighter control on SG&A expenses. So it was really looking at the scenario on how we envisaged this to happen. It was important to right-size the company to the level of cash that would be available to run. And we've done all steps that are required for that. On the outlook for the year, I believe Q2 will be challenging as we continue to see spurts of local lockdowns that keep happening. In fact, in a recent study that we conducted, which was an 11-day study that was going on, at the end of the 6th day, 4 patients had tested COVID positive. So the entire study had to be scrapped. Now, these are not things that we are kind of used to in the past. So there are some learnings that are there. We do expect the normalcy to return in the fourth quarter. I'd like to highlight that the fall in revenue and earnings is a temporary situation, and our order book is relatively strong, and we will see an uptick in revenue as our capacity utilization comes back to near normal levels. This is a quarter in which we've taken steps to prioritize safety, flexibility, and efficiency. We remain confident that we will emerge from this crisis more agile and more efficient than ever before. With this, I would now like to open the floor to questions.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Mehak from AB Consultancy. Please go ahead.
Hello. Yeah, thanks for taking my question. Good afternoon, everyone. So I just wanted to understand how COVID has impacted your order book and how do you see it moving forward? Like, what is your outlook on the same?
So there are twofold impact of COVID on the order book. First, what happens is that some of the trials get paused. So in all, for us, 29 trials have been paused, 11 in APAC and 18 in the US geographies. So when the trials get paused, sometimes clients have a rethink on how they want to reset the trials. So we've had a degrowth in order book with close to 57 million, which had to be reset in terms of that. And this I'm using it from the order book of 31st December 2019. The second one is that the closures, because the site activity is not there, several clients take time to close the RFPs because they know that the trials are not going to start immediately or going to start in a few months. So the order closures take a bit more time than what was traditionally happening. And third, we also, while in a COVID case, we can start the trial immediately. For us now to start a trial will take a couple of months. So a site activation, by the time it will be a few months before the site activation happens. So we've lost some orders. Some orders have been paused and will wait for sites to open when they start. But I'm happy to say that the level of RFP activity is now at pre-COVID levels, and therefore we should start seeing an addition to the order book from Q3 of this FY.
Okay, understood, sir. Thank you so much. I'll get back in queue for any other follow-up. Thank you.
Thank you. The next question is from the line of Nirav Dalal from Maybank. Please go ahead.
Yeah. Hi. Thank you for the opportunity. I had a few questions. One, the order book of 173 million. This is executable over what period, and what is the confidence that the entire order book would be converted into revenues? That is my first question.
Yeah. So, Nirav, thanks for this. It's a great question. So first, I want to call out that this order book has already been adjusted for the closure of EU, and otherwise it was higher, but we've removed so this is a net addressable order book which is there. Now, normally we used to consume our order book between 8 and 10 months. But the consumption of order book will really depend on the site activity. Given where we are, I would assume that we are now not going to be in the 8 and 10 month cycle. It may be 12 to 14 months kind of a time frame. That's my guess as we speak. But it's eminently possible that there is an acceleration that takes place during Q4 of this year, when we may revise our guidance of consumption of this order book to much higher levels.
Got that. And what would be the split of services and clinical of the order book? Because I believe services would happen faster than the clinical side.
No, when you say services, you mean regulatory and PV?
Yes. Yeah,
okay, because clinical is also service.
No, the reg and PV. Yeah.
We can get that data across we can get that to you. But
Not an issue.
However, I would say that you need to understand that Reg and PV, except for the life cycle management business, which is there in both, the
Correct.
rest are the rest are basically, it's a lag indicator. The original data for everything comes only from the clinical trials. So
True.
it can't be too much ahead of the curve. So we should not read that one set of business is completely insulated from the other set of business. That is not the way to read this.
Okay. And the other question was regarding the provisioning that we have done. What would be the split of cash and non-cash in that, or would it entirely be non-cash, meaning goodwill being written off on the books, or certain intangibles being written off on the books? So I just wanted some indication on that.
The entire 20.73 million that is a write-off is the net asset value of the investments in EU as in the books of our subsidiary Ikron Akinova Limited.
Correct.
It does not pertain to any goodwill write-off on the books of Take Solutions. This is the actual net asset value and may include a very small portion of the goodwill which may be there in the books of Ikron Akinova Limited. So you should treat this that this is largely a cash write-off and not a non-cash write-off.
Right. Got that. I'll come back for follow-up questions. Thank you.
Thank you. The next question is from the line of Yash Jain from AG Investment. Please go ahead.
Good evening. Thank you for the opportunity. I have two questions. First one is on the clinical trials. As mentioned earlier that the clinical trials were halted due to the lockdown. So have they started now that we are in the unlock phase in most of the regions? If yes, at what level are we as compared to the pre-COVID levels? And by when do we foresee getting back to the pre-COVID levels? Do we see the impact of COVID being there for a longer term or not?
So the answer to that is yes, the lockdown is lifted, but the clinical trials take place in what are called as sites, which are either hospitals or clinics or our own facilities. Today, the site activity is about 35% of what it was in the pre-COVID levels. In April and May, it was almost nil. Now it is at about 35%. Our expectation is that it may go back to normalcy during Q4 of this year or maybe Q1 of the next FY. So it is certainly rebounding, but the pace of rebound, it is anybody's guess.
Okay, understood, sir. Thank you. The second one is some medium to near-term outlook on the R&D expense. If you could provide, that would be really helpful. Thank you.
That is R&D expense within the company, or you mean a macro number?
Within the company.
No, there is no capex or any R&D expense that is planned at the moment. We've put that on hold for FY21.
Okay, understood. Thank you for that, sir. That's it from my side.
Thank you. The next question is from the line of Tushar from MK Global. Please go ahead.
Thank you for the opportunity. It's Tushar Bohra from MK Ventures. Just a correction, please.
Yes.
Sir, just want to understand, we had a normal run rate of about 600 crore revenue pre-COVID, right? Mm-hmm. In the exit quarter pre-COVID, and which has now come down to about 150-160 crores. So what part of this is exceptional situation, and what part of this could be a sort of a permanent near-term loss, and will have to be rebuilt as business? So let's say once things return to normal, will our run rate go back to 600, or will it be like 450, 500? How do we look at it?
See, that's a great question. So let me tell you that what we've done is we've readjusted our capacity to about 60% of pre-COVID levels. So our capacity itself, therefore, is now, let's say, if you use 600 as an example, our capacity is at now about 360, 370. And even when we come back to the normal run rate, first we'll hit that before we expand capacity. So is that the question you're asking? Did I answer it?
Yeah, partly. What kind of capacity are we talking? Like, it's not a hard asset sell-off, right? We're talking of site reduction and resource reduction, if I'm not mistaken.
Correct, but they can't bound back because, see, these are resources that are who have strength in domain. So it's not like hiring an IT programmer. So it is at different locations across geographies. So even if there is a site, even if there is a study, for us to activate a site and to go ahead with the study, there is a few months of preparation. So our existing capacity, we do have, by the way, sites are hard assets. We do have access to sites and we do have our own facilities. So let me give an example. We have 208 beds in India spread across 3 locations for doing our BA/BE studies. Now, the revised guidelines of ICMR, which has come including social distancing norms, that 208 capacity stands reduced to somewhere 164 or 165. And that has a commercial implication, right? So the capacity reduction is on 2 counts. What is there, which is coming in terms of guidelines from different regulators? And second, what is the reduction that the company has planned for itself, foreseeing a particular revenue run rate? And this we are trying to marry it as close to the actual demand as possible. I hope this gives a color.
Right. So second, if you can just further expanding on this, if you can help understand, let's say how many resources have been laid off, and broadly, you mentioned regulated markets or front-end markets. So how many people have been laid off, and what percentage of your employee costs and other costs comes down permanently from when we look at next couple of years perspective? And second is with the COVID studies that we have now started to get, can we expect that even if the lockdown situation continues, and given that there are a number of vaccine trials and other trials for COVID, our clinical trial operations overall may not go back to the lows of Q1?
I'll answer the second question first. Yeah, it won't go back to the lows of Q1. We now have an uptick, and I'm happy to tell you that even besides COVID studies, other studies also are starting with the site activity, which is there. Now, sorry, what was the first question?
I wanted to understand in more granular details what has been the actions, let's say in terms of cost reduction, employee reduction, and so on.
So we were doing an employee cost run rate of about 29 million for the quarter in the pre-COVID times, and our aim is to bring that down to about 15 million by Q2 of this FY, which will be somewhere around 14 to 15 million in Q2. In terms of SG&A expenses, we were operating at about 25 million approximately per quarter. We're trying to bring that down to the $5 to $7 million range. There is already a lot of travel has been cut down, a lot of marketing and conferences have been cut down, so there is also something that's taking place in the environment that is adding. We're also trying to reduce the office footprint. And now with the closure of EU, we've achieved several of those milestones already. So you'll start seeing that we will be doing quite well from Q3 onwards.
Just very quickly, you mentioned office footprint and you mentioned the write-offs of EU. Do we expect more write-offs to happen, in the subsequent quarters? Is that a likelihood?
No. I think what we've done is I called out very clearly See, when you have to conserve cash, you have to make cash available for the best geographies and the best entities that you are going to support, and which is precisely what we've done. We did not have enough cash generation to cross-subsidize any entity, and EU required the most. Just to give some data points, for Q4, the loss in EU was $2.3 million for us. And as we moved into Q1, we would have lost at least 7-8 million in EU just on Q1. And Q2, so that requires cash funding, and that was not possible for us. So we've retained the units that are cash generating and self-sufficient and trying to grow that back. So there will be no more write-downs.
But the amount of cost reduction that we are seeing, so we are bringing down our SGA by 80%, and employee costs we are trying to bring it down to 50% of previous levels. Does it not squeeze us in terms of competitiveness or in terms of being able to deliver performance? And can you also share whether such similar measures have been taken at larger CROs, or put these steps in context with the industry?
Okay. See, there are a number of questions here, so we need to break it down into different parts. So first, I think we did what we think was needed to conserve cash and improve liquidity in the system. And that is a decision that we took as a company, and we are confident that those decisions were right. So now, it meant reduction of some of the capability. So if you ask, do we have the same capability to launch back again after 2 months? The answer is no. But have we right-sized ourselves to what we see as a demand environment? The answer is yes. Now, next is what have the other CROs or the bigger CROs have done? Most of the bigger CROs have raised a lot of capital in this, and see, they are in geographies where the availability of capital is higher. So most of them are sitting on piles of cash, more than a couple of $1 billion in cash. We don't have that kind of strength, so we have to right size to what we needed to do, which is there. But overall, there is an EBITDA that is down for everybody. There are cost containment measures that are being taken everywhere. Everyone's sites are affected. It is not unique to us. So the macros of the business continue to be the same for everyone.
Got it. Just one last way quickly from my. You mentioned capex reduction, or rather the cash conservation. So does this also mean that until we are able to go back to maximum utilization on this reduced capacity, we should see a tone down of capex over the next 2 years, unlike what was envisaged earlier?
In FY21, there is no capex. We've put zero capex on the table. And for FY22, we will take it as time comes. I don't think we will say that there will be no capex in FY22. That may not be the right way to look at it. But generating cash and having free cash flow is really the focus at the moment. And we intend to be free cash flow positive in Q3 of this year.
Right. Thank you so much, sir. I'll join back with you.
Thank you. The next question is from the line of Nirav Dalal from Maybank. Please go ahead.
Thank you again for the opportunity. A couple of questions. One is on the 2 acquisitions that we had done, Dataceutics and the clinical research company. The leadership is still intact there, or there has been a change in that? And the operations in the US geography particularly, how is that moving?
No, the leadership is very much intact, and both the entities have been fully integrated into our system. I want to call out that this company, we pride ourselves on the capability of leaders. We have at least 50 very, very strong leaders and more than 300 plus domain experts. And we retain that fabric even during these tough times. So, yeah.
Okay. And just quickly on the balance sheet side, if possible, can you share the net debt number, or anything on the receivables, so that we can have idea in terms of how the balance sheet is moving?
Yeah. So I think we have reduced debt by about 1.2 million during the quarter. $1.2 million during the quarter. So in terms of Lalit, what is the debtors?
Debtors reduced by 150 crores from 800 crores to now 700 crores.
The debtors is reduced by 150 crores during the quarter.
Okay, great. Okay, thank you.
Thank you. The next question is from the line of Tanushri Agarwal from SKP Capital. Please go ahead.
Good afternoon. Thank you for taking my question. I just wanted to ask, what are your near-term targets, and by when do we expect to get back to profitability? If you could give some color on that. Thank you.
Yeah. So near-term target obviously is to get back to positive EBITDA territory and net profit. I'm quite confident that in Q3 we will be there. As we speak, we expect even for the month, this month we will be profitable. So all the measures that we've taken and put in place, we're quite confident that we'll be very soon in the green.
Okay. And do we have any peers in India?
No, we don't.
Okay. Thank you. I will get back in the queue.
Thank you. The next question is from the line of Mehak from AB Consultancy. Please go ahead.
Yeah. Thanks for the opportunity. So I just wanted to get your view on, do you think the impact of COVID is, here to stay? Is it going to be for a long term? Or are you hoping or expecting for, signs of revival in the coming months? I wanted to get your view on that.
There are two different parts. I think COVID, obviously, we don't expect it to be a cure to that or a vaccine to that anytime soon. We're not seeing that. It may still take a few months to a year before that is out. So, but the activity levels of activity with the revised norms of social distancing and safekeeping, we are seeing the level of activity pick up. When it will get back to pre-COVID levels is we are really hoping that by the time we come to Q1 of FY22, it will be near normal. And by Q4 of this year, we'll be perhaps at about 75-80% of what was at pre-COVID levels.
Okay. And so what strategies or steps are we taking to deal with it? Like any short-term strategies that we have implemented, to get back to profitability, to minimize the impact on the activities?
Yeah, I explained that. See, our short-term strategy is really to conserve cash and bolster liquidity and come back to profitability. For that, we've addressed cost upfront and straight on in a very, very aggressive way, and that's yielding results. We are seeing a revenue uptick. We are seeing a better conversion of the order book that we are having. So with both these, we'll be profitable very, very soon. I expect Q3 to be a profitable quarter for us.
Okay. Thanks. If I may ask one last question. So have you applied for moratorium during COVID-19? And I mean, if yes, if you could throw some light on it.
See, to the extent of the loans in India, which are, we have applied, but most of our loans are dollar loans from Singapore, and there is no moratorium as far as those loans are concerned.
Okay. Thank you so much, sir, and wish you all the best.
Thank you.
Thank you.
The next question is from the line of Anish Munka from GST Investments. Please go ahead.
Good morning, everyone. Sir, could you please give us a subsequent breakup of the life sciences business, like how many projects are in phase 1, phase 2, phase 3, and phase 4, And what are the success rate for each phase, approximately, sir?
I won't have that offhand now, but we can reach that to you if you can just query us, and we'll. The second part of the question I didn't understand. What are the success rates means what?
So what, like from phase 1 to phase 2, how many projects go from phase 2 to phase 3 subsequently?
That is not a function of the success of the trial. It's generally a decision that is taken by the sponsor company. And there are several points that they consider, not only the success of a trial. So let me give you an example. There may be a very successful phase 2. But if a competitor has just launched a drug in the same space, you may not want to move ahead with a phase 3. You may drop that and then go ahead and do some other trial. So there are several aspects which sponsor companies take into account when they move a trial from one phase to another.
Noted, sir. So my other question
would be the efficiency and safety of what you're trying. Yeah.
Yes, sir. So my second question would be, sir, I got from our employee costs is like our average employee cost per year ranges from 40 to 45 lakhs per annum. Compared to other listed CRO players, it's like quite high, as like 3x or 4x. So do you have some points on that, sir?
I don't know where you came up with this data. I don't think that data point is right. If you can write to us on how you computed this. I don't think
employee cost divided by total number of employees. So employee cost is nearly 650 crores and total number of employees is 1,500. So from that I found. Yes, sir.
Where is the 650 crores of employee cost? In this quarter?
No, sir. P&L, sir. Yearly P&L from FY20. I was going through the annual report and I found that.
No. There is
So what is the average employee cost per year, sir, of your company?
See, normally our employee cost is about, I told you it was in the region of about 29 million. And now it has come down to will come down to 15 million by the end of this quarter.
15 million per quarter, sir?
Yes.
Okay. Thank you, sir. That'd be it.
Thank you. The next question is from the line of Tushar Bora from MK Ventures. Please go ahead.
Sir, very quickly, couple of questions on follow-up. Are we looking to raise capital, any kind of equity funding or anything on the anvil?
No, in the listed company, we are not anticipating any form of capital raise. We may look at different forms of, if there are any other assets like the supply chain asset that we sold, to bolster liquidity, we always keep looking at different strategies.
But nothing on the listed company?
No.
Right. Second, sir, if you can, with the European operations being sort of effectively wound down, this is the operations that was the original Actinova, right? The original German operations that we acquired?
Yes.
Is that correct?
Yes.
So
that company had two operations. It had Asia operation and it had Europe operations. We acquired and we built it up. But I think we took the right decision now given the circumstances that were there.
So effectively, does our operation base in Europe go to zero, or do we still have operation space after this on the CRO side?
No, we have a methodology of partnering with other CROs in that area to deliver studies. But on our own, we are not seeking studies in Europe now.
Okay. And if you can comment on the on the US acquisition, how has that progressed, and the overall strategy of integrating and expanding basis Sky and data center?
I think we've done well with the integration of both those acquisitions. They have stood us in good stead even in the tough times. And we are anticipating that as things come back to normal, there will be a strong growth. We've also enabled quite a bit of offshoring out of those entities. So in good times, it should be able to tell very favorably on the margin profile that we have.
Right. So I see that we haven't given a breakup of the different services, revenue breakup. Could you help us with that for this quarter?
I think we will address that subsequently in a mail to you.
Thank you. Ladies and gentlemen, due to time constraint, that was the last question. I now hand the conference over to Mr. Srinivasan HR for closing comments.
Ladies and gentlemen, thank you very much for participating in this Q1FY21 earnings call of Take Solutions. Obviously, it's been a very difficult quarter, but my management and we are taking all steps possible to come back very quickly to profitability, and we are quite sure that Q3 will be a profitable quarter for us. Have a great rest of the week and stay safe. Thank you very much.